Hello everybody, welcome to Leeb's marketforecast.com video for the 15th of April 2013. It was truly a pretty bad day. Stocks were down big. Gold has the worst one-day drop in more than 30 years. And of course, we still have that horrible, still developing situation in Boston. For the video, I want to focus on gold, which has fallen to a 2-year low and is off roughly 30% from its record highs set in September of 2011. What really got the ball rolling was Europe forcing Cyprus last week to sell the bulk of its gold reserves to help repay the ECB for the emergency loan. But it goes beyond Cyprus. Cyprus is seen as a model for future bailouts, and the ECB's willingness to force the sale of gold to cover the soaring bailout costs eliminates the metal's role as currency, at least for now. But gold had also been acting strangely since the release of the Basel III proposed liquidity regulations. These regulations were released in January of this year and outlined assets that could be included as a liquidity buffer in the event of a repeat of the financial crisis of 2008. Gold, the best performing asset during that period, was curiously missing, while assets such as equities and low-rated bonds were included. Clearly, the message from the BIS, often called the Bank of Banks, was that gold should not be counted as currency. Then along came Cyprus and the forced confiscation of private savings, and gold didn't do too much. And then there was the Bank of Japan's massive quantitative easing, which is about 3 times the size of our own QE. That is when taking into account the fact that the US's economy is about 3 times that of Japan's. And then there's, again, Cyprus, where the central bank of Cyprus and its government had a fight, and the government won out. It insisted that the country follow the instructions from the EU, ECA, and IMF that they should sell their gold. The amount was $500 million, which is a relatively small size, but the symbolism was loud and clear. You should not regard gold as currency or store of value, and with a delay reaction, the route was on. We had a problem with the videos, so I'm going to have to re-record the second part. Continuing, further adding to the pressure on gold has been the drumbeat from the Fed of an early end to QE, suggesting a drying up of liquidity. But keep in mind 2 things. First, recent economic data since the last FOMC meeting has been on the whole much weaker than expected. And 2, that if QE were eliminated, it would be likely done so on the heels of higher inflation and commodity prices. What we're getting at is that the West is desperate to maintain the dollar and the euro as reserve currencies. They are desperate that goes in the background lest they lose control of the commodity prices and virtually everything else in the monetary realm. Now, we're not conspiracy buffs, but everything that we've seen suggests that the West, in ways that are not necessarily illegal, are trying to put a lid on gold prices. Now, it may work for a while, and it has worked for a while, but we think that eventually gold will find its way into a reserve currency basket, and in the process will likely advance much higher than where it is now. And just going back to the euro, until now, Germany with its deep pockets has been strongly motivated to hold the eurozone together. Now, while it's true that it has doled out huge sums of money to help out its struggling fellow Eurozone members, but the export-driven German economy has also benefited immensely from having a weak currency by virtue of its membership in the Eurozone. Return to Germany's own currency, the Deutschmark, would immediately bring Germany's export engine to a standstill. An unfettered mark could easily be a Lehman-type event, or perhaps even worse. Speaking of Lehman, it's interesting to note that gold first fell about 20% before the Lehman event. While it's too early to say that a big decline is ahead for stocks now, our internal stock indicators are bearish, and the stock market has also just set record highs last week. So the environment is ripe for a fairly sizable correction. We think that it would behoove investors to be cautious. That's it for today. Thank you for watching.